While the media focuses on inflation, the real trigger for the next financial shock and a historic surge in silver is hiding in Japan. For decades, the global economy has been secretly fueled by a massive flow of cheap Japanese money from a mechanism called the yen carry trade. Nate Saint here with Peak Life Wealth, helping you protect your hard-earned money from inflation and build real, lasting wealth. In this video, we'll explain exactly why this multi-trillion-dollar trade is unraveling and how its collapse could be the trigger that sends silver to seemingly impossible triple-digit highs. So what is the yen carry trade? The idea is simple. For decades, the Bank of Japan kept interest rates near zero to fight deflation. This created a golden opportunity for huge financial players like hedge funds and banks. They could borrow colossal sums of yen for practically nothing, swap that yen for US dollars, and invest it in higher-yielding American stocks or bonds, pocketing the difference. It was essentially free money, scaled up to an unimaginable degree. This flood of borrowed cash became a hidden engine for global markets, inflating asset prices everywhere. The entire system was built on one critical assumption, that Japan's free money would flow forever. That assumption is now broken. After decades of deflation, Japan now has persistent inflation. So, the Bank of Japan is finally being forced to raise interest rates. For a trade built on zero-cost money, this is a dagger to the heart. As Japanese rates rise, the yen strengthens against the dollar. For traders who borrowed trillions of yen, this is a brutal double whammy. Their borrowing costs are rising, and the yen they need to repay their debt is becoming more expensive to buy back. This forces them to frantically sell other assets, US stocks, bonds, to buy back yen and close out their loans before losses spiral. Now, what happens when all these leveraged players rush for the same small exit at the same time? It creates a terrifying cascade of selling that can ignite a global market panic. This isn't a Japan story. It's a direct threat to the world's financial plumbing. The fire hose of cheap money that propped up asset prices for years would be turned off completely, forcing a rapid, painful deleveraging across the entire system. Before we connect this chaos to a historic opportunity in silver, please take a moment to hit subscribe if you find this analysis valuable. We specialize in connecting these big-picture trends to tangible ideas. In the first phase of this unwind, panic selling hits the market. Traders sell everything, including gold and silver, to raise cash. But it's what happens next that creates the opportunity. As the wave of selling threatens to freeze global credit markets, central banks like the Fed would be backed into a corner. They'd face a stark choice: allow the system to collapse, or pivot back to their only solution, printing massive amounts of money. This moment of policy panic is the critical step. For investors, this pivot would be the ultimate proof that global debt is unmanageable. It would trigger a profound crisis of confidence in all paper money, forcing capital toward tangible stores of value, starting with gold. But silver could be positioned for an even bigger move. A price like $150 an ounce is speculative. It's an exploration of an extreme, but plausible, outcome. The kindling is already in place. Silver's fundamentals are incredibly strong, with demand from technologies like solar panels and EVs consistently outstripping mine supply, creating a deepening physical deficit. The yen carry trade collapse would be the match that lights this fire. As central banks pivot, investors would flee paper assets. Gold would lead the charge, but investors would then look to the much cheaper, poor man's gold, silver. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, is at a historic high, meaning a reversion to its modern-era average would require silver to dramatically outperform gold. This could ignite a powerful feedback loop. A rising price attracts retail FOMO, while industrial users hoard supply, further squeezing the market. And here's the key. The investable silver market is tiny compared to stocks or bonds. It's like pouring an ocean into a teacup. Even a tiny fraction of global capital shifting into the metal would be enough to cause a parabolic price spike. If you want to stay prepared, go to the link in my bio for the free inflation-proof wealth system guide. It's the guide I wish I would have had years ago. So to put it all together, the thesis for $150 silver is a multi-stage scenario, not a forecast. It begins with the unwind of the yen carry trade, cracking the foundation of cheap money leverage. This forces a pivot from central banks, shattering confidence in paper currency. This crisis of confidence then drives capital into hard assets. In the tiny supply-constrained silver market, that rush for safety could create an unprecedented price explosion. The tremors starting in Japan could trigger the financial earthquake that sends silver to unimaginable heights. I'm watching things closely and will keep you updated as this unfolds. You now know what most people don't. The next update could change everything, so make sure you're here for it. Stay sharp, stay stacked, and I'll see you in the next one.